It all started with one word, just one, a single catastrophic miscalculation that literally pushed the world's biggest economy right to the very edge of the abyss. So you see, the official forecast, it was calling for steady growth. You know, business as usual. But what actually happened? Well, reality delivered a shock so big, it didn't just miss the mark, it completely vaporized it. That huge gap you're looking at on this slide, that isn't just a rounding error. That's the chasm that swallowed an entire economic model whole. All the experts, all the algorithms, every single one of them dead wrong. This wasn't some little course correction. It was a total failure of imagination. And, a mistake that big, well, it brings with it an equally massive consequence. We're not just talking about a recession here. I mean, we've seen those before, we get how they work. No, this was something else entirely. This was a complete system failure, like the entire economic heart of the nation just seized up. -15%. Just let that number sink in for a second. A 15% contraction of the GDP. That absolutely dwarfs anything we've seen in modern history. I mean, to put that into perspective for you, the 2008 financial crisis, that triggered a drop of around 4%, and that was spread out over a long time. This was nearly 4 times that damage, and it hit with the speed of a hurricane. It was basically an economic heart attack happening in real time, and nobody knew how to stop the bleeding. But here's the thing. This isn't a story about the end. Not at all. It's really the story of what came next. It's about how the United States pulled off one of the most incredible economic comebacks we have ever seen. This is a story of survival, of total reinvention, and ultimately of a nation completely rewriting the rules of economic power for the 21st century. All right, before we dive deeper, just a quick but really important note for everyone watching. This explainer is for educational and entertainment purposes only. It is not financial advice. Please always do your own thorough research before making any kind of investment decision. Okay, so to really understand this incredible comeback, we have to go back. We have to look the catastrophe right in the eye. We're going to dissect that exact moment when everything just broke. We need to see just how close to the edge we really were and trace the chain of events that kicked off the darkest economic chapter in almost 100 years. Amidst all the charts and percentages, this is the number that really, truly matters. 25 million. And that's not just some data point, right? That's 25 million lives turned completely upside down. We're talking about more people than the entire population of Florida at the time, all thrown out of work in just a few months. Think about that. A generation of careers just gone. Families facing foreclosure, communities that were once thriving just completely hollowed out. The strain on the system was one thing, but the psychological damage, that was a whole other crisis. And it created this wave of fear that no one seemed to know how to stop. This was the real human cost behind all the headlines. So the big question is, how did it all fall apart so fast? Well, it was a cascade failure, a perfect storm where one domino knocked over the next with terrifying speed. It all kicked off with an initial market shock, what economists now call the sovereign credit cascade of 26. Basically, a corner of the debt market that no one was watching imploded, sending a shockwave around the world. But the real damage, the killer blow, was stage 2. The credit system freeze. You have to think of this as the economy's bloodstream. It's where banks lend to each other, where businesses get the cash to operate day to day. And suddenly, it just stopped. All trust evaporated. And when that happens, even perfectly healthy companies can't make payroll. That, of course, leads directly to stage 3, mass layoffs, those 25 million jobs we just talked about. And when people stop getting paychecks, they stop spending. That brings us to the final stage, a total industrial output shutdown. Factories just went dark, supply chains snapped. It was a vicious, self-feeding death spiral. And this quote right here, it perfectly captures what all the smartest economic minds were thinking at the time. There was this feeling of just absolute hopelessness. I mean, all the usual playbooks, totally useless. Central banks couldn't just cut interest rates. They were already at zero. They tried printing more money, what they call quantitative easing, but it was like pouring water into a bucket full of holes. Confidence was so shattered that banks just hoarded the cash and businesses flat out refused to invest. The system wasn't just sick, its core mechanics were broken. Policymakers were flying blind in a hurricane with no map. And this chart really drives home how deep the damage went. This wasn't just a Wall Street problem. No, this tore through the real economy. Look at manufacturing, the supposed bedrock of the nation. It collapsed by an incredible 40%. Consumer services, restaurants, retail, travel, the very engine of modern jobs, slashed by 35% as people just stopped spending money. And the housing market, the cornerstone of wealth for so many families, saw a quarter of its value just vanish, kicking off a whole new wave of foreclosures. It wasn't just a few bad parts. The core engines of the entire economy had all seized up at the exact same time. But it's often in those darkest moments that something new is born, right? And out of that sheer desperation, a plan emerged. It was a response born out of pure necessity. Because when the old rules don't work anymore, well, you have to write new ones. And this was the turning point. It was an audacious, nationwide gamble to do what that economist said was impossible: to defy history and pull the entire economy back from the brink. The entire plan was built on one pretty controversial idea: strategic industrial policy. Now, this was a complete 180 from decades of economic thinking. For generations, the idea was government, just get out of the way, let the market work its magic. This new model said the exact opposite. It argued that in today's world, with all its competition and fragile supply chains, the government has to be a strategic partner. We're not talking about old-school central planning, but about actively picking, nurturing, and protecting the industries that are absolutely vital for the country's security and future growth. Now, you can imagine the debate was intense. Critics were screaming corporate welfare, saying governments are terrible at picking winners. But the supporters fired back, arguing that doing nothing was the only guaranteed way to fail. The gamble was on. So, how did they do it? The whole strategy rested on three incredibly powerful pillars. Pillar number one: stabilize the financial core. This was like emergency room triage. But instead of just handing out blank check bailouts, they did targeted capital injections. The catch? The government got equity stakes in return, and there were strict new rules on executive pay. The goal was simple: get credit flowing again without rewarding the bad behavior that got them there in the first place. But that was just step one. Pillar two was to ignite innovation sectors. This meant pouring huge amounts of public-private money into the industries of the future: AI, biotech, advanced materials, you name it. The government was basically acting like a venture capitalist, funding the risky early research to encourage private companies to jump in. And then, pillar three, the most radical of all: reshore critical supply chains. The crisis laid bare a huge vulnerability. The country was relying on other nations for essential stuff like computer chips, medicine, and green tech. This pillar used a whole toolbox of incentives to bring that advanced manufacturing back home. The new mantra was resilience over short-term efficiency. And what's so fascinating here is the massive philosophical shift this represents. The old way of doing things was completely reactive. We just wait for a crisis, then run around trying to clean up the mess. It was this endless cycle of boom, bust, and bailout. This new model? It was proactive. It was about building an economy that was strong by design. It was about looking ahead, identifying where the world was going, and insulating the country from shocks before they could happen. Basically, it was a shift from being the economy's firefighter to being its architect. Okay, so the theory was definitely bold. The strategy was clear. But the million-dollar question is, did this crazy gamble actually pay off? Let's get to the results, because this plan didn't just restart the old American economic engine, it built a completely new one from the ground up. Just look at this. This right here is the DNA of the new American economy. And what happened wasn't just a recovery, it was a total reinvention. Technology and AI, which got all that investment from Pillar 2, now make up a staggering 40% of the entire economy. Advanced manufacturing, a direct result of that reshoring plan, is now a solid 30%. And that focus on next-gen energy, it created a huge 20% share and achieved total energy independence. This is not your parents' economy, driven by consumer debt. This is a high-tech, production-first powerhouse built on a foundation of innovation and pure resilience. Now let's zoom in on that tech explosion, because these numbers are just mind-blowing. A 300% year-over-year growth in AI development. That's not just a statistic. That was machine learning suddenly showing up in everything from medicine to shipping. This was that Ignite innovation pillar firing on all cylinders. The data really suggests that all that public seed money created the perfect environment for private sector genius to just explode. From there, the build-out of data infrastructure and automation created this incredible feedback loop, with each breakthrough fueling the next, powering the whole recovery. And hey, this comeback wasn't just about software. That reshoring pillar sparked a legitimate manufacturing renaissance. But these were not the old-school factories. This table gives you a perfect before and after picture. The factory output index didn't just bounce back, it blew past its old peak. And look at high-tech exports. We're talking pharmaceuticals, advanced computer chips, aerospace parts. They tripled from $300 billion to $900 billion. But most importantly, this created jobs. 6 million new, high-skilled, high-paying jobs. People started calling them tech-collar jobs because you needed this blend of hands-on skills and digital know-how. This rebuilt the very towns that the crisis had nearly destroyed. Now, when you have a domestic transformation this big, it's obviously going to have massive ripple effects around the world. The US didn't just stumble back to its feet, it completely changed its place on the world stage, and in the process, redefined what it even means to be an economic superpower in this crazy disruptive era. And you can see that divergence so clearly right here. While a lot of the world was stuck in this post-crisis funk, dealing with fragile supply chains, the US just hit the accelerator. Its GDP growth rate consistently blew past the global average. Its score on key innovation indexes, which measure things like R&D and new patents, put it in a league of its own. And success like that attracts money, a lot of money. Foreign direct investment poured in as global companies raced to get a piece of this new, booming, and most importantly, resilient economic system. It was a flight to safety and a flight to growth all at once. This chart really says it all, doesn't it? In the chaos that followed the global crisis, the United States became the world's undisputed safe harbor for investment. That strategic industrial policy created an economy that global investors saw as not just cutting edge, but stable, shielded from the geopolitical storms hitting other parts of the world. The US became a magnet for global capital, which just poured more fuel on its own fire. But it wasn't just cash, it was a brain gain. The world's best and brightest scientists, engineers, and entrepreneurs all wanted in, creating this incredible, virtuous cycle of talent and innovation. So, after all that, what are the big lessons here? What can we take away from this incredible story? Because this is way more than just a history lesson. It's practically a blueprint filled with powerful lessons on strategy, resilience, and just plain survival for any business or even any nation in this age of constant disruption. All right, let's break down the key takeaways. First and foremost, the power of a long-term vision. This whole strategy worked because it wasn't about hitting next quarter's numbers, it was about building the next quarter's century. Second, you have to adapt to massive economic shifts. The comeback happened because leaders had the courage to let go of the dying parts of the old economy and go all in on the future. Third, the strategic value of supply chain security. This went from being a boring logistics issue to a core part of national security. Resilience itself became a huge competitive advantage. And finally, maybe the most important lesson of all, having the guts to invest heavily in innovation when everyone else is panicking. It's the ultimate contrarian move, and as we just saw, it can change absolutely everything. And all this leaves us with a really critical question for today. In a world where crazy shocks seem to be the new normal, is just waiting around for the next crisis even an option anymore? Is building proactive resilience the only real strategy left for survival? Let me know what you think. And hey, thank you so much for watching. If you got value out of this deep dive, do me a favor and hit that like button and subscribe to Capital Casualty for more deep dives into the economic and business stories that are shaping our world.